want to start recording so that I can give him a shout out? Did you already start recording? Hey, so everybody on YouTube, this is Periscope. The link is right here, right? And everybody on Periscope, that's YouTube. So definitely make sure that you actually follow the YouTube channel, all this stuff. The link and everything is, well, there is no link in, no, the link is going to be actually in my my website. So if you go to my bio in Periscope, armanvakili.com, the YouTube channel and everything is going to be there. So I'm ready. You ready? You want to put all these stuff out of the way? Put all this stuff out of the way, all this stuff out of the way. I have my notes and I am ready to go. We good? Is this thing in the way? It's not. Cool. Okay, so here we go. Here we go. What's going on, everybody? My name is Arman Vakili, and this is episode 11 of the Hashtag Everything Money show, where we talk about everything that has to do with money. I'm super stoked that we even made it this far. I feel amazing today. We have Periscope live right now. Everybody's watching, and Deji, the big man with the master plan, is behind the camera. We had a great day today. We did a lot of shooting this morning, just an overall productive day, and we have a great day of shooting ahead of us today. So it's going to be a pretty interesting day. I'm going to get a lot done for you guys. I rocked my favorite sweater for episode 11 because it's kind of an important episode in my opinion. And so we're going to get into it. Today's episode is actually on one of the topics that I think it's kind of it's a little bit controversial because most people don't like saying it out loud, and there's so many disclosures that you have to make that you can't fully give like a one-size-fits-all answer. So this specific episode is not going to be a one-size-fits-all answer. It's mainly going to be an awareness type of a thing. I want you guys to know what's available to you in this general category, which is the way that your investments get taxed. And so there's something called capital gains taxes, and then there's something called estate taxes. And every single investment that you have is subject to both of those things, capital gains taxes and estate taxes. Now, unless you actually go hire a trust attorney to actually design a trust for you, where you put your assets within that trust, whether it's an irrevocable living trust or revocable, doesn't necessarily really matter. As long as the assets are in that trust, when you pass away, estate taxes can be avoided without doing the strategy that I'm going to share with you right now. But there's this other part of it where if you don't want to go get an estate lawyer or like a will lawyer, trust lawyer, whatever it may be, if you don't want to go through all that and actually hire that person, the easiest way to do it is to put your money inside a cash value insurance policy. Now, insurance policies, typically when people think about it, they don't look at it as an investment, they look at it as a cost. There's a cost to get this insurance policy on my life or my family's life. But there is a way that you can actually hide cash value. And you don't want to use the word hide because the IRS doesn't like it, Uncle Sam doesn't like it. But you can put cash value inside a cash value insurance policy. You can put your money in there and it'll start accruing interest. Now, what happened was when they originally came out with these plans, like the cash value insurance plans, this was something that was done maybe, I don't know, like 50, 60 years ago. Actually, I have no idea what the exact time of it is. I don't know what the history is, so don't quote me on that. But it was decades ago. It was decades ago that they came out with the first ever cash value insurance policy. And that was the whole life insurance policy. And it was super expensive. It didn't earn much cash, and so people didn't like it, and they didn't want to invest in it. After that came something called universal life, and it was still a fixed interest rate, but it was just a little bit higher than the whole life. And again, people didn't like it because it didn't offer too much of a return, but it was a little bit better, right? But it still wasn't technically considered an investment vehicle. Now, what happened was when the government and all the different insurance companies started offering something called a variable universal life, which means you could actually tie the cash value that's inside your policy to the variable market. So the S&P 500, NASDAQ, Dow Jones, Hang Seng, so on and so forth. You can actually tie it to the variable markets. And there were people that were earning 18%, 19, 20% returns on the cash value of their insurance policy. And it was fully tax deferred, so they didn't pay any taxes on that money. And then because of the fact that it was hiding inside an insurance policy, they were able to leverage it and actually get access to the money, also tax free. And then when you pass away, obviously because of the fact that it's an insurance policy, your family is your beneficiary, everything gets passed down to them and they don't have to pay estate taxes on it, because the way that insurance works is that you've already suffered a loss, and because you've suffered a loss, then you shouldn't have to end up paying another price for it. So typically what people don't consider is the last option, which is called an indexed universal policy. An indexed universal life policy, what it does is it gives you a floor, a bottom against the market crashing, and then when the market goes up, you actually can go up with the market. And so you won't get negative ever, where the variable market would actually go negative. This will never go negative. And then on average, let's say you'll get 4 to 6%, not 46, 4 to 6% return, and that's considered a fixed policy because it'll never actually lose value on it. And so you get that, and in a good market it may even go higher, right? But so if you really want to be secure and you don't want to lose your assets, you go indexed. You never necessarily go fixed anymore, like fixed, solid fixed rate. You'll typically go indexed. And then if you have some time to risk, or if you're willing to risk a little bit, and if you're willing to be a little bit more aggressive, you can even go towards a variable policy. But then you just have to be fully aware of the fact that there is loss associated with variable policies. And so that's just the basics of it. I don't want to get into too much detail into this specific episode because you can kind of run away with all this information, and I don't want to go over anybody's head yet. So I just want you to be fully aware that there is a way that you can fully avoid capital gains taxes. And to kind of give you an idea, if you got 10%, let's say, or we're talking to Periscope right now, and they're actually interested in these different interest rates, right? And so if you got, let's say 4%, we're talking right now, so 4%, if you get that and you don't have to pay taxes on it, and you actually get to take the entire 4% home, that's worth it. If you're gonna end up getting 8%, because some people talk smack and they're like, yeah, but I can get you 8%, 4% is crap, so on and so forth. But it's like, okay, factor two things. If you're going to get 8%, for sure it's not fixed. So you know it's variable, and you know that there's a risk that you can lose your money. That's number one. The second part is, for sure you're going to get taxed, because it's either in a mutual fund or some kind of an IRA. And for both of those, unless it's a Roth IRA, but even in a Roth IRA, you still have to pay taxes on the money that you put in there, up front at least. But unless it's like, a mutual fund, traditional IRA, anything that it's tied to the market, you're going to end up paying taxes on that money. And so if you're going to get 8%, for example, everybody thinks capital gains taxes are going up. So if you're going to get 8% and you have to pay 60% in capital gains tax, or 70%, 80% in capital gains tax, it doesn't make sense, because you end up losing way more and then we're not even considering fees and all these different things. So it's just a good option for you to consider. It's not for everybody. If you would like to see if it does fit you and your unique situation specifically, let us know. There's going to be some kind of a link in the description below that will allow you to speak with one of our licensed insurance agents, and they work within our company. They get access to about 10 different insurance carriers, so they can shop around for you and give you really good rates, and then they can just answer all of your questions to see if you even qualify for these plans, because of the fact that it's a tax-free plan, and because of the fact that you don't pay any taxes on the growth of your assets, and you get these guarantees, all these things, you have to go through a qualification process. So they may let you know that you don't qualify. Typically about 30% of people don't qualify, but if you want to find out if you do qualify, you can just go ahead and request a free consult with one of our licensed agents through the link below, and we'll talk to you later. I think that's pretty much it for episode 11. I hope you liked it. It was pretty quick, pretty straight to the point, and it was a lot of condensed value. So I hope you liked it. And one thing that I want to start kind of pursuing at the end of every episode is I need questions from you guys. And I'm talking to Periscope too. You guys need to send me questions too. Send me questions that is customizable to your life. Whatever you want to know about money, whether it's retirement, insurance, debt, taxes, how do I make more money, how do I start a business, whatever it is, let me know. I would love to be able to answer it for you. And what we'll do for you, the same way that we did for one of our friends in the earlier episodes. Can I do it now, and then you can plug in the episode? So episode 2 was the one with Brandon. where we answered his question? It was starting from the bottom. It was episode 2. So episode 2, bam, right here is going to be episode 2. So episode 2 is going to be an example of what we did for one of my friends who actually asked the question. It was through Snapchat. And so he asked the question, and then I gave him promo, and we promoted his Snapchat, so on and so forth. So whether you want your blog to be promoted, whether you want your website to be promoted, you want your Instagram account, you want your Twitter, whatever you want to be promoted, just ask your question, and then I'll make sure that I will include your username or your website when we actually go ahead and use your question for content in the future episodes. My name is Arman Vakili. I really hope you enjoyed the episode. This was episode 11 of the #Everything Money Show. I hope you enjoyed it. I will see you in the next one. Oh, by the way, follow me on whatever social media platform that comes up right after the screen. And subscribe to the channel, comment, like, share it with your friends. Tell everybody that you know, blah, 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 blah.